All right, so welcome to another episode of DUCKit. Today we have a very interesting guest, somebody that I met a few weeks ago. His name is John Sharp. He's a partner at Hatcher Plus. He's on the show because he provided a refreshing approach to the role of funds and how they can operate in this kind of new world that we live in. Hi, John. Thanks for taking the time to make it.
Chris, my pleasure. Great to be here.
So we caught up, I would say, I don't know, probably been a month now. And our initial conversation was about an hour, probably could have gone on for about 10. The reason being, I think we really hit it off in terms of our perspective on the way funds operate. And, you know, the region isn't really familiar with Hatcher Plus, but I really think they should be. And that's not because I'm getting a commission or a cut of anything, but that's because I think that what you do is really different and really refreshing, something that I think that could have a really good positive impact on our market. So to start, could you explain to us what Hatcher Plus is and what makes it so different?
Yeah, thanks a lot. So basically what Hatcher Plus is a reaction to an earlier fund that we had that was a very traditional VC fund. And I got into this fund because I was an angel investor. I was working with several other angel guys. And eventually the other angel guys asked me to run the fund. And so I became a full-time venture capital guy without any training or anything else. I don't think there's a university out there for venture capital. If there is, actually maybe the Kaufman Fellowship is the closest thing. But so I jumped into this VC fund and quickly discovered that basically being in a VC fund and running one as a partner is really just about applying very subjective judgment to just thousands and thousands of decisions across a very long time period, all of which add up to a rather low probability of success. You know, when you add them all together, you've got to make 100 decisions correctly for things to turn out pretty well. Sometimes it's very similar to what founders, the decisions that they make, right? And so at the end of our investment period around 2016, we'd invested in 13 companies. We'd made 20 investments in total, about 20 million bucks, including in Teller, by the way, in Dubai.
Yeah.
Just down the road from where you're sitting right now, which has worked out really well. And so we'd made all these investments, but at the end of the period, I just felt like every day turning up to work was like turning up at the casino. I felt like I was rolling the dice, and people had given me money and they were giving me their trust to do good things with this money. And so in a classic kind of ready, fire, aim scenario, we announced that we're doing a $100 million second fund. And then we actually paused and we went, wait a minute, are we really comfortable going out to the market with a $100 million fund and doing the same thing again, knowing that we're really rolling the dice? Wouldn't it be more interesting to understand how the dice rolls? Are there ways in which the dice could be coerced to roll more often in a particular direction? So we just started asking some really basic questions about whether or not it was possible to remove some of the risk from venture capital and from venture investing. And that's what started us down this whole sort of path of Hatcher Plus, because Hatcher Plus is simply a play on our earlier fund, which was called Hatcher. But I guess the plus stands for the fact that we're now using a lot of data modeling, AI, technology. We've invested about $7 million in technology over the last 2 years. We'll invest another 5 to 6 million in the next 2 years. So we're building up a really big repository of data and a platform that's designed to work on the basis of that data. But before I go there, we probably should have a discussion about what we found out when we went down this rabbit hole in the beginning, because that's the most interesting part, I think, because it's interesting not just to investors, but it's also interesting to founders. Because when you start looking at the numbers, it's super interesting what goes on in venture capital, and it's not often talked about or very clearly understood, I think.
Yeah, I think there's a huge misconception. So even on my side of the table, even before I ever made an investment myself, I had this interpretation of the VC world that has a very scientific approach to how they did things. I really believe that. I really believe that team of financial analysts and that whole kind of organization had a very kind of smart approach to their investments. Fast forward a few years, maybe a few investments myself, and kind of grown a network in the VC space. I just come to realize that that's simply not true. it's maybe a bit more sophisticated than an angel investor, but it's not that much more scientific, right? In the
Yeah,
sense that,
I completely agree with that, but I'd characterize it a bit differently in the sense that, and I don't think you're saying that they're not smart, because I actually am of the opinion that most people in VC land are super smart.
yeah,
I mean, they got there because they're a successful entrepreneur, or because they've made a bunch of money, or whatever reason that they've ended up there. And so I actually think one of the problems in venture is that everyone's super smart, and that we actually end up fooling ourselves, into believing our own bullshit a little bit, right?
yeah,
Because we start thinking, oh, I'm super smart. But in a probability-based world, which is the world we live in venture, if we're all super smart, then you have to remove that from the equation because it's no longer relevant. So then you have to start asking questions, well, what does my deal flow look like? Am I really getting great deal flow? So I'm super smart, let's just put that aside. Am I getting great deal flow? Am I meeting the right kind of founders? Am I putting in place the right kind of process? Am I using my biases to exclude things that I shouldn't be excluding? And so then it becomes actually removing the smartness and saying, well, what am I doing right about my process? And the only way to start is to start with a level of analysis into how everyone does business in venture capital and what works. And so what we did in 2017 is we went out and we spent hundreds of thousands of dollars buying data, and we bought hundreds of thousands of rows of data. It took us months to clean it all up and to start to organize it and understand it. But at the end of that beginning, or the beginning of the analysis, if you like, we started by saying, okay, what do different sized funds, what kind of outcomes do they have? And we discovered that small funds, meaning small groups of companies, they have two outcomes. Typically, they have a zero outcome. It just goes terribly wrong. There's the middle outcome, but that no one talks about. And then there's the fantastic outcome. But very few of these small funds, only about 25% of the funds that we observed have this outcome that you'd talk about at dinner, right? And all the other ones were like sub NASDAQ returns or returning zero. And we think this is really fascinating. So then we started studying larger and larger funds, and we ended up building a simulation engine, and we built 4 billion with a B venture funds using 600,000 deals. And the reason we did that is we wanted to exclude all these really smart partners and their decisions. And we just wanted to say, what if it was any set of partners in the world building these funds that are ag tech or ad tech or health tech? What if we looked at every sector, every geography, every stage, and we just lined it all up and took a view? And so that's what we did. And 4 billion simulations later, we just came to the conclusion that there's a really simple way that you can look at venture. And that simple way is, if you throw a small net into the ocean, you may end up with one of those prize tuners that's worth hundreds of thousands of dollars in that fish market in Tokyo, or you may not. And the probability is you won't, because it's a small net. But if you cast a really large net into the ocean, you may end up with several tuna. And CV Insights and several other groups, there's a lot of empirical data out there now, show that you'll get a unicorn for every 1 in 100 externally funded companies, meaning venture-backed companies. So there's a 1 in 100 chance to get a unicorn once that company has had venture money put into it. So an early Noon, an early Fetcher, an early, name any company, Kareem, there's a 1 in 100 chance it's going to go on and become a unicorn. So if there's a 1 in 100 chance, right, and you've only got a 20 company portfolio, what are the odds? They're not great, right? They're roughly 20%. And so that's exactly how the data lined up for us. So we did all this work only to come to this enormously simple conclusion that you just really need to have a very large portfolio of startups. And the only thing I'd add to that is you need to be very selective in what goes into that portfolio. And we did a lot of studies on this with 160 VC firms and discovered that on average, they select 1 in 100 business plans that get submitted to them. So with that knowledge in hand, we came up with this theory that basically startup investing is a 1 in 10,000 shot, because only the unicorns return the fund. Everyone else is useful to the returns, but you have to get some unicorns in your fund for it really to work. And at the other end of that, the startups, you've got to look at 100 startups typically as a leading professional investor before you pick one to put into your stable. So it's a 1 in 10,000 shot.
So I have two main comments or questions on this. I just really want to get your perspective. So a couple episodes ago, we had a guy called Philip on our show. He runs Magnet, which is a regional kind of startup kind of data, I would say, house for the region. And he was sharing some interesting stats. He was saying since kind of the pandemic and in Q2 of this year, we've seen generally in the region a huge drop in deals, in investments. And the VC space has really reduced from a volume perspective the amount of investments that they've made. However, the size of those investments have grown, right? Because most of their investments are later stage. And so those investments need, I guess, more capital, et cetera. And so, you know, it's extremely strange. Like, I completely agree with your perspective. I think it's very rational, super logical, you know, multiplier effect, you know, definitely makes sense. But what's your kind of feeling on what's actually happening in the region? I think I'd love to get your perspective because it seems to be the opposite of what you believe, right? So, you know, we have more VCs. We supposedly have more money accessible than we've ever had in our life, but we have even less investments than we had in Q1 of this year. Now, sure, there's a pandemic, but generally speaking, I'd just love to see your perspective on that.
So my perspective is pretty positive. I mean, I've been coming to the region since the late 90s and spent an enormous amount of time there in various countries. I think there's some enormously positive things going on, particularly in Saudi. I mean, Saudi is just like, I witnessed the change going on in China from the early 1990s to the 2000s, and I thought that was rapid. But it's nothing compared to what's going on in Saudi.
Amazing. I grew up there. I got to tell you, I'm shocked. I love it.
Yeah, even Saudis are just incredibly surprised at how incredibly fast the change is happening, and it's so positive. I just think it's great. So I actually think that a lot of this, to your point, can be put to COVID. We saw a lot of accelerators around the world. We work with about 40 accelerators, and we co-invest with 15 of them. And we saw a lot of them cancel cohorts that were autumn, summer cohorts. They've pushed back winter cohorts till 2021. And we recently called all of them and we said, look, yeah, what are you doing? Yeah, what's going on? And a lot of them, some of these guys made zero investments and zero cohorts in 2020. So I don't think it's a MENA thing. I think it's a global thing. In 2021, everyone that we polled is actually going to do more investments in 2021 than they did in 2019. So I think there's a couple of things that are going on that are really just a result of COVID. So my kind of macro view, and I don't have your view on the Middle East or anyone else's that's probably listening to this. The only thing I would say from my personal perspective is I think this slowdown hit the Middle East pretty hard. There's a lot of there's not this great rural population in the Middle East, right? Everyone lives in a city. And so I think there's reasons why this hit the Middle East pretty hard. We're all going to just have to deal with that. And I think people are going into 2021. But every one of those accelerators that we called recently, they've all moved to virtual cohorts, virtual mentoring. Everyone's adjusted. I was on the phone with Flat Six Labs in Bahrain last night, actually, just chatting with those guys. They're doing everything virtually. So I think everyone is moving to that sort of modality. And that's global. But next year, we expect it to be identical. There'll just be a lot more Zoom calls involved.
And so on that point, I guess the follow-up question to that is, and just to give a bit of insights to the people listening, your business model is based on volume, and you were just saying how you have 15 incubators or accelerators that you work with globally. Yeah. Can you explain that deal flow process for us a little bit?
Sure.
Is it a manual process? Is it with people? Is it with data? How does that actually happen?
So what we tell accelerators is if they want to use a highly efficient process and they can use our platform, which we've spent millions of dollars developing, it's really good. But we'd be stupid if we insisted that everyone did that because it would cut down half our deal flow. Because other people have developed platforms, some accelerators have their own platforms. Some people are super comfortable using Excel, terrific. Yeah, as I say to some people, you can send us data on clay tablets and we'll figure it out. I mean, we don't care how the data gets to us or how an application gets to us. We just want to see the application. So we rely a lot on the accelerators to do the parsing of the data. And so it's very important that those humans are in in the mix. I did a blog a couple of days back where I kind of explained our methodologies, and we use AI very much to do the data modeling around our investment model and how we construct portfolios. But when it comes to selecting startups, it's really down to what the accelerators see, because let's say that someone submits via our platform and they get a 300 out of 1,000 score, which is a pretty lousy score on our system. And then the accelerator decides to invest in them. Well, we're going to back that decision because the humans have seen something we didn't see with our AI. There's something about that founder that they want to back. There's something about the team that they're seeing. So for now, what we do is we just say, well, that's interesting what the score is saying, but we'll back the humans. And so we will get a lot of deal flow next year. We'll see around 30,000 deals globally. And we'll invest in 1% of those deals. So that's a lot of deal flow. It's a big chunk of the deals that will be actually submitted globally. But what we're also seeing happening is with accelerators, for example, I've been to a couple of Startup Istanbul events in the last couple of years as a judge and just as an attendee. And those guys get a massive number of applications, but they get applications from all over the world, Chris. They get applications from all over Africa, all over Central Asia, all over Asia, America. And when you're on a boat with all those guys, with all the entrepreneurs at the meet and greet sessions, you're meeting people from like 40 different countries. So what's happening, I think, in the Middle East as well is you're seeing much more involvement for surrounding countries and people applying to Middle Eastern accelerators and VCs for capital, which is exactly what you'd expect, right? It's when Singapore set up, all the VCs here started getting inundated with calls for capital from around the region. So I think the Middle East is actually going to also become that. Yeah, well, it's already there, right? It's already a hub for investment from a lot of folks. And so that's a really positive aspect of what we're seeing.
Absolutely. I think I'd love to ask you about kind of the impact that you think COVID could or could not have on your modeling, because all of your, I guess, your business model is based on looking at data, looking at, I think I read earlier, 600, 700,000 different kind of data points to kind of build out your business kind of strategy. Now, how much impact does a pandemic or something like COVID have on these models, and how worried are you that that's not factored in?
So we were quite worried at the beginning of the year when this thing first started having an effect, because just as one example, we've backed an accelerator in Milan, Italy, which was one of the worst hit early on. But I can actually give you a very quantified answer, because we just finished doing an audit with PwC, and they insisted, because of COVID, that we contact every single one of the 110 companies that we'd invested in. So we talked to them all and we said, how has COVID affected you? And are you still in business? You're getting funding. And there were less, here's an interesting statistic, that there were 30% less failures than we expected during 2020. So 30% is a big number. So less companies failed than we expected, and only 3 companies out of 110 failed because of COVID. Isn't that amazing? And they were all travel and hospitality startups, by the way.
Wow. Oh, wow.
So we've seen very little. Now, you could ask the question, and I'm sure that would be your next question, what's going to happen next year? We're seeing companies, because there's a bit of stuff went around earlier in the year about the fact that people would be bottom feeding and everyone would be pushed down in valuations. And I'm sure founders looking to this would be interested in any insight on that. And we've seen a couple of people attempt that, but by and large, it's been pretty normal. People have gotten the round they expected, have gotten the round that they deserved. We haven't seen people coming in and taking advantage of this situation, because we typically don't set terms, right? We're a follow-on investor. We follow a lead investor. We're a financial investor by and large. So we're forced to accept the terms that are on the table, right? When we take over pro rata. So for us, it's been very gratifying to see companies do 4x, 5x, 3x their valuations during COVID and closing that. We closed on $5 million ourselves in May into our management company at the very height of COVID. So it's been disruptive, but it's been nowhere near as disruptive as the news media may have us all imagine. Most of the startups have stayed pretty resilient.
And in terms of, you guys are generally agnostic to industries, but has the pandemic forced you guys to kind of be more bullish on some over others, just by the natural kind of state of the world?
We may not invest. If a travel and hospitality accelerator was to approach us right now, we may decline respectfully the opportunity.
Okay. Yeah, I mean, I would expect that answer. Yeah. Sure, makes sense. Yeah.
Look, it's interesting, isn't it? Because I'm enormously bullish on the next 5 years, because one of the things that the COVID's done, right, is it used to be a 5-year approval process to get a vaccine approved, and now it's what, 6 months?
Yeah. Who knows if that's a good thing or a bad thing, but we'll see. Time will tell. Time will tell.
I think there's probably a reason there was 5 years there in the first place. But let's just assume that's good for investing, right? Yeah. So it's that. Medical devices. So if I come up with a new way to do a ventilator tomorrow, right? Do you think that's going to take 2 years to go through? No, it's going to be massively compressed. Look at fintech in the Middle East, which we know a bit about with our involvement in Teller, right? All the regulations, everything's getting done at massive pace compared with the last 5 years. So what that translates into is the 2 longest J curves that we found in our research were fintech and medtech. They're the 2 longest. It just takes a long time to get your money back, and eventually it goes sprinting into the atmosphere and you do really, really great. But it takes a long time to get those companies to break even and then to profit, mainly because of the regulatory issues. So that's all changing. So we would predict in the next 5 years that there's going to be a massive amount of value creation. This is actually an ideal time to start a startup. Why? Because you've got the quantitative easing that's kicking in even more now. We all expected that by now. It's actually killing it. For anyone who doesn't see understand what that means, it just means there's a lot more capital out there that people can invest in startups or in whatever they want to invest in. You look at what's happening now with the regulatory stuff, with the amount of capital that's flooding into the market. This is all very, very positive. But and then if you look at the last time there was a big crisis, right, the financial crisis, what happened 6 years later? We had the biggest crop of unicorns that's ever existed in humanity, right? So I'm pretty bullish on what's going to come out of all this stuff in the next 5 years.
Yeah, I mean, to be honest, even on an individual basis, myself, I'm extremely excited. I'm multiplying my bets, right? I'm probably more active as an independent person than I've ever been on anything. Any idea that I've ever had, any startup concept that I've been sitting on for a couple of years, any investment that I was scratching my head, with all of that, I'm moving on. So
I'm very glad to hear you say that. It means that after this podcast, you're going to get as many requests for funding as I am.
Hopefully, man. Hopefully. And I say that, with full conviction. I think in all kind of crises, in all kind of challenges, I think the opportunities multiply, right? And I think there was a specific, I would say, pause that people were holding on to. And I think that was the US election, to be honest. And I think everybody was just so consumed by that event. And I think now that that's passed.
We're all just so distracted, Chris. Yeah. I mean, it was just a giant distraction.
And it's just so funny. Now that it's passed, I feel like everybody's now focused on other things. And I think everyone's accelerating and everyone's waiting for 2021 and everyone's super excited. And so I really believe that the next 3 to 5 years, like you said, are going to be a huge opportunity for those that have the kind of courage to jump in.
I agree. And I think that the process of finding capital has become more efficient as well, because the whole process used to be the physical sort of engagement with an investor used to involve like a meeting and lots of sort of, getting coffee and working trying to get the damn video thing to work and whatnot. And now it's just so efficient. Everyone jumps on Zoom, you're sharing data. I think this is never going to go away now, because it's so much easier for founders to engage with investors now, because it's a much more efficient process, which means we can do more of it.
Absolutely. I have kind of a question that I've always wanted to ask you, and even from the first time that we spoke, I wanted to ask you this question, but I forgot to ask. In your kind of, I think in some of the documents that you shared with me originally, it explained that 50% of your investments will be in the US. And I don't have an issue with that, but I just want to understand it. So just as an approach, there's kind of a more established, a bit more mature market, and then there's emerging markets. And so from somebody who's sitting in, kind of hard to call Dubai an emerging market when you look at the rest of the region, but when you look at the Middle East as an emerging market, generally speaking, and a more mature market, how do you as a fund determine the kind of weights of those investments and how much you want to play in this market versus that market, and why generally?
Yeah, it's the simple answer is it's historical. So our investment models are built on historical data. And so to be true to them and to output the returns that they tell us that we're going to be able to get, we needed to look at the data and say, okay, the data is 50% from the US, 20% from Europe, MENA, 20% from Asia, 10% the rest of the world, including Australia, New Zealand, etc. So we needed to look at where the data was coming from if we were going to accept what it was telling us about what the returns would be. But here's some interesting information, right? If you look at the latest Cambridge Associates data, and I love Cambridge Associates because they tend to tell us it is. Yeah, they don't dress up the data. I think it's a really good data source for us GPs and for LPs as well that are looking for good data. What they say is that the emerging markets in emerging venture investors are starting to do better on a regular basis by several percentage points of IRR per year. So this is great news for MENA-based VCs, for Asian-based VCs, for people that are ex-America is the way that they categorize it. So, and it's great news for companies, for startups that are looking for money, because the more that a MENA-based VC can show that it's going to be a couple of percentage points better than traveling all the way to the US and attempting to shove money into a US-based VC, that means that they're going to be able to put more money locally. It's better for the ecosystem and everybody wins. So everyone deserves credit for that, right? There's a lot of startups now that are quite robust in the Middle East that weren't around simply 5 or 6 years ago, right? Yeah. So that's one aspect of it. But the other thing is we've now got a lot more data. I mean, data on ex-US places really only started around 2008. And we know because we've bought all the data that's out there. So if you look at where that data has come from predominantly for the last 20 years, it's been the US. And what we've started to do is adjust for some of the performance that we're seeing in MENA and East Asia. Like China, no meaningful data really exists before around 2010. So as the more meaningful data comes in, we're starting to adjust our portfolio construction models and look more towards investing ex-US. And that's why it's kind of a 50-50 thing. It's nothing to do with our preference for a US-based company because we frankly don't have one. We're as likely to invest outside in Chile or Sydney or Tokyo or Dubai as the US from a pure unbiased standpoint. We'll just invest in good ideas and good founders. We don't care about language. We invest in USD and euros. That's pretty much our story. But the returns that we're seeing are really starting to solidify from places outside the US, and that's the story I'd like to get across to anyone listening, because it's really important that people realize that this is no longer a riskier bet. This is actually a slightly better bet from a risk-return perspective.
That's really kind of a great thing to hear. And those data points of the success rates improving in the region are going to have an impact on how many investments you make in the region, I'm assuming. And if your business model is based on volume of deals, then your participation and hopefully your volume participation should actually accelerate that trend as well, right?
Yes, correct. And by the way, look, there's some awesome entrepreneurs in the Middle East. We've seen a lot of really good deals from the Middle East over the last few years. One of the deals that we famously didn't invest in our first fund was Fetcher. We were offered I think some crazy deal, 5% for $100,000 or something at the time. And so we're a bit disappointed we didn't take that up. But we did invest in Teller and bring that to market. So that's exciting. Look, there's some really, the thing about the Middle East, which is really quite fascinating to me, it's a much younger place than many of the other places that we try and work in. I was on the phone earlier with some groups in Japan, And for example, and there, it's a much older, kind of more conservative culture there. Nothing against Japan. It's just speaking factually, right?
Yeah.
Whereas in the Middle East, whenever I meet someone, it feels like they've been in university in the last like 10 or 20 years, right? And everyone's quite young, and there's quite a dynamism there that's absent in other parts of the world. So I do think that the Middle East's best years are very much ahead of it with respect to how things are happening in the biggest markets, like in Egypt and Saudi, and the greater stability and just the greater emphasis on entrepreneurialism and second economies in those countries. So yeah, without sounding like a rabid fanboy, I really do feel quite positive for what's going on in MENA and the region generally. I think it's a very young, very high consuming market, and I think there's certainly a lot left in the tank there with respect to future business models and entrepreneurial deals that we'll be able to invest in, hopefully, and make some money out of.
I want to share with you an interesting kind of survey outcome that happened a couple of weeks ago. On LinkedIn, you can set up a survey and you can send it to your network. I set up a survey, and obviously I'm not Cambridge over here, but I'm kind of in touch with my network. And so I sent this survey out, and I said, on an individual basis, assuming you have enough cash to cushion the next couple of years, what would be the bet that you make the most, right? What would you invest in the most? And I gave 4 options. I gave real estate, I gave the stock market, I gave gold, and I threw in crypto. And I didn't put VCs, because I didn't think that was actually a consideration for individuals, right? Because I wasn't talking to funds, I was talking to...
That would have been the best option, though. That was the obvious option. So you had to leave that out so you didn't bias the results, right?
Exactly. So it's so interesting because the outcome of that survey had about 300 people respond in my network. And my network just is generally startup, entrepreneur, and quite a few investors and VCs and stuff, but generally it's entrepreneurs. And so we had about 300 people respond in the region, and it was so interesting. The majority, and my age group, startuppers, tech guys, I was really surprised, but the first most selected answer was real estate. Shocked me, completely shocked me. The second one was stock market. The third one was gold, and the last one was crypto. Now,
wow.
it was
that shocked me a little bit as well.
It shocked me completely. Now, of course, this is not a good quality survey and shouldn't be referred to as a reference for the region, but it completely shocked me, and it led me to kind of we're going to have another podcast where I'm inviting people to represent each of those choices. So somebody from a stock market kind of product, investment product, somebody from real estate, gold, and crypto, and we're going to have this debate. And I can't help now but think, because especially after the last conversation we had last time, is that a fund like yours doesn't necessarily refuse individual investors that want to invest, $100,000 or $200,000.
We embrace that.
Absolutely.
And we have a product.
And so I'm starting to realize that one, I should have included VCs. I don't think what you were saying originally, I think that's true. I think I should have included that as a choice. And then second, how come, in your opinion, I'm just curious, because to me I was completely shocked. How come my audience is still picking real estate, in your opinion, as the number one choice?
That's such a great question, isn't it? Because, so I do think MENA and where I live in Singapore are different, right? Because urban environments, it's not like you can go and buy that £15 million manor house that's an hour out of town. It doesn't exist, right? Or it does, but it's more likely to be a farm or something. It's a little different. The interesting thing is I spoke with a large pension fund on Monday, and we're talking about this thing because the guy's chatting with us in charge of alts, and I was saying, look, everything that you're investing in right now that you guys are investing in as a fund is changing. Yield, fixed income's going to zero. Public equities are super toppy. I mean, really, does anyone think that the Nasdaq's going or the Dow's going to 36,000? I mean, maybe, but a bit of a bet. They're involved. So yeah, let's just assume that it's hit the top for a little while, and they're factored in the next 5-year earnings, which I think a lot of people are saying. So then you get to real estate. Well, what's fascinating about real estate is if you look at what's happening in central London at the moment, people are moving an hour out, 2 hours out because they're scared and they're worried this will happen again. Same thing's happening in New York. I was talking with someone in Melbourne a couple of days ago, and they're saying exactly the same thing's happening in Melbourne. And that if you put up a property for sale, a farm or something, it's like 2 hours out of Melbourne, boom, just gets picked up the next day. Isn't that interesting? So I actually think, and commercial real estate has some ungodly amount of money coming good or coming due at the end of the year, right? With all of the deferrals that have been offered by people, that still has to happen within the calendar year. They're hoping to get it done. I think commercial real estate is really tricky going forward. There's a major bank in Australia that just announced that they're basically sending, a third of their staff home for good. This is a trend. It's happening now. So commercial real estate's going to depopulate a little, which is or a lot, depending on what your thesis is. So I'm a bit mystified that about real estate, except for the fact that you're talking MENA and urban communities. I think that may be what makes it different. But certainly in places where there's a rural option, whether it's the US, the UK, Australia, which is the three that I have personal knowledge on, I think that real estate is going to become quite volatile in the near future.
It's funny. The more I scratch my head and the more I try to figure out why people would select that, I always land on the same kind of perspective that it's a panic investment. I feel that a lot of people in the Middle East that are generally well off or wealthy or have that disposable cash are worried of a devaluation of currencies given the markets, and they're so afraid of anything else that's a bit more sophisticated because they're either not aware, misinformed, not educated enough. And so even if real estate is going to lose 10, 20% of its value in the next 3-5 years, I realize a lot of these guys and girls still trust it because they understand it. And so I think it's a panic investment to offload cash into something that they understand rather than generally believe that it's going to be the best investment. Right? I think it's more. I would agree with that. Yeah. I kind of feel like that's
the mindset. Also, well, I think you have to look at who your network of advisors is, right? And for a lot of people making their first foray at like 30 or 40 years old into the investment market, who's the advisor? The advisor's dad, right? Dad and mom, you go to them, you say, look, I'm thinking of buying a house. And they go, good one, son, good one, daughter. Yeah, it's a great investment. Now, if you go to mom and dad and you say, look, I'm thinking of investing in this VC company, right? Or I think I'm investing in crypto. You're not going to get pat on the back from mom and dad. That they're just going to look at you like you have two heads and like you're making a foolish decision. And so I think part of what we face as non-real estate investment opportunities, even in startups directly, right? Part of the thing is people that are used to investing in these long-term things like real estate, like bonds, that your dad and mom are going to invest in. It's very hard for you to go to your inner social circle and get support for these investments. Decisions if you're going slightly off to the edge. Now, your decision itself in isolation may be the best possible decision that you can probably make. I think an investment in us is a really good decision. But unless that gets support from your inner group, whether that's your inner group as an institutional investor or you're in an inner group as a family office or even as an individual within a family, you've got to have that support internally. And so real estate's so easy because you're going to dad and dad's already done real estate his entire life, right? Especially if he's in MENA. And so it's a much simpler decision to get support from your network, I think.
So then in order to kind of get your...
The dime's still talking there, but I do think it's an easier bet.
Yeah, absolutely. And I completely agree with your approach. I think that's what most people go to in terms of their kind of cycle of making a decision, for sure. Their inner circle has more impact than anything else in the world. To put that into perspective, I would just love to get your kind of view of this. So if you were to answer this survey and you had $10 to invest today and you had 5 options: real estate, stock market, gold, crypto, or a VC, Hatch or Plus. Of those $10, How would you split them? How would you spread them?
$10 in Hatchet Plus, of course, Chris.
Stupid question, I guess.
But having done all of the above, right? I think that it's incumbent upon to look at what your long-term goals are. The typical investment in venture is a 10-year decision, right? And it may turn out to be a 15-year lockup for your money. Now, yes, you'll get money from a typical venture fund, you'll get money as things exit, and it may quickly add up to be the same amount that you invested. So you may feel pretty good about that and happy to leave your principal on ice for a few years. But when someone signs up for a VC fund, it says in the contract your money's going to be locked up for 10 years. That has for a long time acted to dissuade people from investing in venture funds, because they go, you know what, I'm 50 years old, I really want to lock the money up till I'm 60. I'm 60 years old, I want to lock it up till I'm 70. And so it's a long time to buy in, right? So what we did is we actually created an exchange traded note that allows you to buy in. You can invest $50,000, $100,000 if you want. We'll put that fractionally across 1,300 companies, so it's quite diversified. We'll send you the returns as these companies exit. But more importantly, if you run into a situation where you've got a better investment, you know, want to buy a holiday house, whatever, you can take that, put it on the market and sell it. And so if you're 2x in 5 years or wherever you're at, that's your target, you're at 100% up and you're happy with that, you can then sell out of it. You don't have to stay in there for 10 or 15 years. We think there's going to be a lot, we're a bit of the pioneers in that area. It took us a long time to structure that and put it together. But we think there's going to be a lot more of that coming down the pipe in the next 5 to 10 years, to the point where we wouldn't be surprised if every venture fund, or not everyone, but a majority of them 10 years from now will have some kind of liquidity option. Doesn't require all the other investors saying yes. So I think that's going to be a significant change in how people invest. With that change, that makes venture capital a lot more attractive.
Absolutely, absolutely. I think historically, and especially for me in the survey, the reason I didn't include it is I didn't think it was something that was accessible or worked within the framework of what individuals expect in their investment.
I think it's generally, the VC's been quite inaccessible for many people for many years. Yeah. And the reason for that is it's generally been structured as quite a risky investment. You're betting on a group of guys to replicate their previous fund, and that's not a scientifically provable thing. You know, on that. So what we're trying to do is fit in that middle and have more of a smart beta approach rather than an alpha approach to venture. So what we want to do is kind of sit in the middle between, say, a real estate bet or a fixed income bet and traditional venture capital, and say, look, here's an approach that's very well diversified. It's the level of risk on this is quite acceptable, and the return is pretty solid. So that's really what we're pushing out there as a new sort of form of venture product.
Yeah, absolutely. I think even myself, I'm now considering it quite heavily. And who knows? Maybe we have a conversation later about it.
The other thing, just quickly, real estate though, is it's so hard to find places with good yield now. I mean, I think during our father's time, you know, it was possible to like go and buy something and you'd get that, you know, maybe double-digit yield, or you get that high thing. It's so difficult anywhere in the world now to find a good yield from those investments. So I'd almost put real estate in the same category as the other fixed income kind of approaches, because there's just not a whole lot there, you know.
It's strange. I think most people today that buy real estate, they don't do it generally for yield, especially in 2020. I think they do it for a hold.
Right.
I think that's more how people see it this year. And I think when it comes to yield, Dubai is a special case. You can get some pretty good yield, but generally speaking, globally, I would agree with you. I mean, I have property in a few places, and it's not a really good investment. It's just a hold for the future. But yeah, John, I really appreciate, you know, all the time that you've taken to speak to us. It's been almost an hour. The conversation has been super, super interesting. Is there any kind of closing remarks or anything you'd like to say for people that are unaware of Hatcher Plus, or anything that they should be thinking of when it comes to VCs, at least for the Middle East?
At least in the Middle East, look, I think that, first of all, thanks a lot, Chris, for having me on. It's been real fun chatting about this. And I would say that I know there's a lot of entrepreneurs in your audience that watch this. And so I would say to them that, you know, when you read something like my blog that says, you know, it's a 1 in 10,000 chance to get to a unicorn and whatnot, there's a lot of fat in that argument. I mean, 80% of the business plans that we see are not venture backable for whatever reason. They're a gas station or the Dunkin' Donuts franchise or whatever. They're just not well thought through. So really you're in a sort of 1 in 20 area when you're looking to get selected into an accelerator. And so most really good ideas will make it into that kind of environment. If you get money from an accelerator or from us, you've now got a 1 in 100 chance of becoming a billionaire, basically. You can now take that, that happy step that you've made into a venture investment, getting into a venture-backed company. You've now got a 1 in 100 chance of making it through to creating $1 billion company. And that's super exciting.
Absolutely.
And the only thing I would say there is just get as much advice as you can from as many people as you can. And anyone that's willing to sit with you for a little while that's been through this before, listen to them, listen to their story. Don't take everything as given. Keep on your own story, but there's so much possibility out there. And I always love seeing it when entrepreneurs make it to that sort of status, because they don't expect it. I don't think any of us ever expect that kind of fairy dust to drop on us. And when it does, it just makes you realize that it's all possible. So I would say to any of the entrepreneurs out there, keep doing what you're doing. Forget about COVID. It's got zero relevance at this point, and it may actually benefit you in terms of what you're doing in the next few years. You may find yourself with more revenue and more possibilities than you had before. So stick at it.
That's a fantastic, uplifting message. Thanks a lot for the time, John. Really appreciate it. And maybe we'll have you on the episode when everyone is debating what the best investment is.
Please, I'd love to do that.
Thanks a lot for your time.